Before we dive into specific trades, we must discuss the most critical factor in option selling: margin. When you buy an option, your risk is limited to the price you paid. However, when you sell an option, especially an uncovered or naked one, you are taking on an obligation. The broker requires you to maintain a certain amount of cash or equity in your account to ensure you can fulfill that obligation. Let's look at the margin calculation components. First, premium received. Second, percentage of underlying value. Third, out-of-the-money amount. Margin is what differentiates selling strategies. A strategy with unlimited risk will require significantly more margin than a defined risk strategy. If the market moves against you, your broker may issue a margin call, requiring you to deposit more funds or close the position immediately. As a seller, your return on capital is always calculated based on this margin, not just the premium collected. Now let's switch gears. For the best trading experience, optimize and analyze your live trades on the Dawn app. Subscribe to IndexOrbit. To open your Dawn Demat account, use referral code EJZZI96380. Please note this is an affiliate link, and I may earn a commission at no extra cost to you. Our first strategy is the short straddle. This is the ultimate neutral play where you expect the stock to stay exactly where it is. To construct this, you sell one at the money call and sell one at the money put. In a short straddle, you collect the maximum possible premium because you are selling too expensive at the money options. However, notice the shape of this chart. This is a naked strategy. If the stock gaps up or down significantly, your losses are theoretically infinite. Because you have two naked legs, the margin is substantial. It is often 20% of underlying value minus out-of-the-money amount. You win if the stock stays within a narrow range, but the moment it breaks out, the unlimited risk warning becomes a reality. For the best trading experience, optimize and analyze your live trades on the Dawn app. Open your Dawn Demat account using the referral code EJZZI96380. If the short straddle feels too tight, the short strangle offers a bit more breathing room. This is the most common premium collection strategy for experienced traders. To set this up, you sell one out-of-the-money call and sell one out-of-the-money put. Notice the difference here compared to the straddle. Instead of a sharp peak, you have a plateau. As long as the stock stays between your two strikes at expiration, you keep the full premium. However, the warning remains the same. Front and center, this strategy has unlimited risk. If the stock crashes or moons, you are on the hook. The margin is still high because you are selling naked options. You are trading a lower total premium for a higher probability of success. It is a classic trade-off. You give yourself a wider margin for error in exchange for a smaller paycheck. To optimize and analyze your live trades, subscribe to IndexOrbit and consider opening your Dawn Demat account using the referral code EJZZI96380. Now, for many traders, the unlimited risk of a strangle is simply too much to stomach. This is where the iron condor comes in. It is essentially a short strangle with insurance or wings attached. To build an iron condor, we follow 4 steps. First, sell an out-of-the-money put, then buy a further out-of-the-money put for protection. Next, sell an out-of-the-money call, and finally buy a further out-of-the-money call for protection. Look at the payoff chart. We see a flat top plateau in the center, where we make our maximum profit. But instead of the ends dropping forever like a strangle, they flatten out into horizontal lines. This represents our capped risk. Look at how the risk is capped. By buying those outer options, you have defined your maximum loss from the very start. Because your risk is limited, the margin requirement is drastically lower than selling naked options. The iron condor is a range-bound strategy. You want the stock to sit quietly between your two short strikes. If it moves too far, you know exactly what your worst-case scenario is. This makes it an excellent choice for smaller accounts or for traders who want to sleep soundly at night without worrying about a massive market gap opening. For the best trading experience, optimize and analyze your live trades on the Dawn app. Open your Dawn Demat account using the referral code EJZZZI96380 to get started. The iron butterfly is a more aggressive cousin of the iron condor. If the iron condor is a wide net, the iron butterfly is a precise target. To build an iron butterfly, you sell an at-the-money put, buy an out-of-the-money put, sell an at-the-money call, and buy an out-of-the-money call. Here is the payoff chart. Notice the sharp peak at the center at the at-the-money strike. The sides slope down, but then flatten out into a horizontal line, indicating capped risk. In this strategy, you are selling the straddle at the center and buying the wings to protect yourself. Key features of this trade include a tighter range, higher premium collection, and defined risk. Because you are selling at the money options, you collect a much higher premium than an iron condor. This higher premium also means your maximum loss is smaller. However, there is a catch: pin risk. Pin risk is the danger of the stock finishing exactly at your strike at expiration. If the stock is right at your strike near expiration, the uncertainty of being assigned on one leg while the other expires worthless can be stressful. You have a very narrow profit zone, so you need the stock to stay pinned to your center strike to hit the jackpot. This chart shows the precise profit potential of the iron butterfly. For the best trading experience, optimize and analyze your live trades on the Dawn app. Open your Dawn Demit account using the referral code EJZZI96380. So far, we have looked at strategies where all the legs or options expire on the same day. Now, let's introduce a strategy that plays with time: the calendar spread. A calendar spread involves two steps. First, you sell a short-term option with a near expiry. Second, you buy a long-term option with a far expiry. Critically, both are at the same strike price. Here is the payoff chart. Notice the curved mountain peak centered over the strike price. Unlike a butterfly spread, this curve is much smoother. The logic here is fascinating. You are taking advantage of the fact that near-term options lose their value or decay much faster than long-term options. This is purely a volatility and time play. Key characteristics include positive vega, meaning you want volatility to increase, positive theta, so you benefit as time passes, and defined risk, which is limited to the net debit paid. Because you are buying an option that expires later, your long leg covers the margin for the short leg. Consequently, the margin required is very low, limited to the cost of the trade. You profit if the stock stays near your strike price as the near-term option expires. If implied volatility spikes, your longer-dated option will gain value faster than the short-term one, boosting your profits. It is a sophisticated way to bet on a stock parking at a price while expecting a future rise in market fear or volatility. For the best trading experience, optimize and analyze your live trades on the Dawn app. Use the referral code EJZZI96380 to open your Dawn account today. The image on screen shows our referral code. We suggest you open a Dawn Demit account using the code EJZZZI96380 to start optimizing your strategies. Selling options is not a set-it-and-forget-it business. To be successful, you must have a plan for when things go wrong. These are called adjustment triggers. Most professional traders don't wait for expiration. They manage their risk when the market reaches a certain point. If a trigger is hit, you might roll the position. This involves closing your current trade for a loss and simultaneously opening a new one further out in time, or at a different strike price to collect more premium and give the trade more time to work. Think of adjustments as a safety valve. If the market moves too fast, you don't stay in the way of the train. You exit or reposition. The goal isn't to be right every time. The goal is to survive the times you are wrong so you can keep trading. For the best trading experience, optimize and analyze your live trades on the Dawn app. Use the referral code EJZZI96380 to open your account today. Finally, let's talk about a strategy that every long-term investor should know: portfolio hedging. If you own a basket of stocks, you are vulnerable to a market-wide crash. Instead of selling all your stocks, you can use index puts to protect them. Think of this as an insurance policy. By purchasing put options on a major index like the S&P 500 or the Nifty 50, you create a floor for your portfolio. First, calculate your beta weighting. Then, determine your coverage. Finally, select an expiry, usually 3 to 6 months out. When the market drops, the value of your stocks goes down, but the value of your index puts goes up. Remember, insurance isn't free. The premium you pay for these puts will eat into your total returns. However, during a black swan event or a sharp correction, this hedge is the difference between a minor setback and a catastrophic loss. It allows you to stay in the market with confidence. We have covered a lot of ground today, from the high-stakes world of short straddles to the protective nature of portfolio hedging. Let's do a quick recap. Short, straddle, and strangle. High premium and margin, but unlimited risk. Iron condor and butterfly. Defined risk and lower margin. Calendar spreads. Playing time decay. Adjustments. Have a plan to exit. And hedging. Using index puts as insurance. Successful trading is about managing the trade-off between risk and reward. As a seller, you are the one providing liquidity to the market, and for that, you are paid a premium. Take some time to look at these payoff charts and visualize how the stock price moves through them. In our next module, we will put all of this into practice. Before we go, I want to show you a great way to start putting these strategies into practice. To get the best trading experience, you should use a platform that helps you optimize and analyze your live trades effectively. The Dawn app is an excellent tool for Indian traders, especially for analyzing option chains and managing the complex strategies we discussed today. If you're looking to open a new DMAT account, I highly suggest using the referral code EJZZI96380. Using this code helps support the creation of these educational videos at no extra cost to you. Once you have your account set up, you can start using their advanced charting and margin tools to visualize your iron condors and strangles in real time. Happy trading, and I will see you in the next module.